Hey everyone, welcome to this explainer. Today we're putting on our professional sell-side equity analyst hats to conduct a rigorous, fundamental investigation into one of the most explosive market phenomena in recent memory, SanDisk, ticker symbol SNDK. We are going to look strictly at the hard data today. We're breaking down the operational metrics, the capital structure, and running the absolute valuation models to figure out exactly what is going on behind the scenes of this massive run-up. If you're looking for market noise or momentum hype, well, you're in the wrong place. We are here to read the fundamentals.
Okay, let's dive into this because, wow, this explosive metric is exactly why everyone is absolutely obsessing over this stock right now. Over a single 52-week period, SanDisk shares skyrocketed from a low of $35.79 to a staggering last close price of over $1,562. That is a completely astronomical increase of over 4,265%. Now, when you see an asset moving with this kind of vertical velocity, your immediate instinct as an analyst should be extreme curiosity mixed with a very healthy dose of skepticism.
So that brings us to the literal $229 billion question, because that is SanDisk's current market capitalization. Our objective for this explainer is simple, but it's rigorous. We are going to completely ignore the headlines, the hype, and the momentum trading. Instead, we're going to look strictly at the valuation metrics and the underlying cash flows. We need to see if the company's fundamentals can genuinely support this massive market cap, or if the market has just detached entirely from reality.
Section 1. The Growth Engine. Let's see what's justifying the hype.
Now, I want to be clear right off the bat, the actual data completely dispels the idea that SanDisk is just some empty meme stock. When we look at their trailing 12-month compound annual growth rates, it's pretty wild. Revenue is up nearly 81%. Earnings per share surged almost 265%. Net income grew nearly 388%. And just look at that bottom line. Free cash flow exploded by an unbelievable 2,589.5%. This is the fundamental rocket fuel right here. When a company accelerates its cash generation at this scale, the market notices and multiples expand rapidly.
And this growth isn't just fast, it's incredibly efficient. As an analyst, one of my absolute favorite metrics to look at is return on invested capital, or ROIC. Generally speaking, anything above 15% is fantastic. SanDisk is posting an ROIC of 40.83%. That means for every single dollar of capital they deploy, they are generating massive outsized returns. Paired with a solid gross profit margin of over 37% and an impressive return on equity of nearly 33%, we can confidently say this is a highly optimized, extremely capital-efficient operation.
Crucially, they aren't pulling this off by drowning in debt. Not at all. SanDisk is operating with an absolute fortress of a balance sheet. They have a debt-to-equity ratio of 0. Literally 0 debt. And if we look at their liquidity, they have a current ratio of 4.78, which means they have almost 5 times more liquid assets on hand than they do short-term liabilities. So from a strictly operational and solvency standpoint, this fundamental foundation looks bulletproof.
Section 2. Pricing the hype. Let's look at the relative valuation multiples.
All right, let's talk about the specific multiples the market is currently demanding. And honestly, this is where our analyst skepticism really needs to kick in. The current price-to-earnings ratio is sitting at 54.30. Investors are paying over 17 times sales, not earnings, sales. The enterprise value to EBITDA ratio is way up at 40.17. Make no mistake, these multiples are exceptionally bloated. You are paying a very, very steep premium for every single dollar of sales and earnings that SanDisk is currently generating. The market is basically pricing in absolute perfection.
But to really get inside the market's head right now, we have to look at the forward estimates. We have a trailing PE ratio of 54.30, sure, but a forward PE ratio of just 18.35. The logic here is pretty clear. The market expects SanDisk's incredible earnings growth to continue at such a rapid pace that, a year from now, today's price of over $1,500 will look like a totally reasonable multiple of just 18 times future earnings. So the entire current valuation rests squarely on this massive expected future growth actually materializing.
Section 3. The Valuation Disconnect. It is time for a reality check. Before we jump into the absolute valuation models, let's quickly define a foundational concept: margin of safety. This is the absolute cornerstone of fundamental investing. It essentially means you only want to buy a stock at a price much lower than its actual calculated intrinsic value. This gap is what protects you from errors in your estimates or sudden market downturns. You always want this number to be positive. Keep that in mind as we run the numbers.
All right, boom. Here is the dramatic climax of our fundamental valuation. The market is currently pricing SanDisk stock at $1,562.34. However, according to our discounted cash flow model, which is the absolute gold standard for valuing a company based on the present value of its future unlevered free cash flows, the fair value price of SanDisk is just $215.17. The fundamental DCF model completely and utterly contradicts the market's pricing,
which gives us a margin of safety of at negative 626.09%. Yeah, this deeply negative margin of safety should make any disciplined investor break out in a cold sweat. It mathematically indicates that the stock is trading miles above its intrinsic worth based on the actual cash it generates. There is no safety net here at all. You are buying at a massive, massive premium to fair value.
And just to be absolutely rigorous here, it doesn't even matter which absolute valuation input we plug into our models. If we base our fair value on free cash flow, as we just saw, it comes out to $215.17. But if we base it on earnings per share, the fair value plummets even further down to just $106.25. That creates a terrifying margin of safety of negative 1,370%. The conclusion from the absolute models is totally unanimous. The intrinsic value is simply nowhere near the current trading price.
Section 4. The final verdict.
So, to sum up our core thesis after running all the numbers, internally, SanDisk is a truly stellar operation right now. It is a debt-free, incredibly capital-efficient growth engine that has posted unbelievable year-over-year operational improvements. However, the current stock price completely ignores the discounted cash flow reality. The market has priced this asset for absolute, flawless perfection stretching far into the future. That leaves exactly zero room for any macroeconomic headwinds, slowing demand, or fundamental execution errors. Which leaves us with the ultimate, timeless investing dilemma. You can identify a spectacular, fundamentally sound company with zero debt and surging cash flows. But if the market price has entirely detached from its intrinsic value, the risk profile changes completely. So as you digest these metrics, ask yourself, are you willing to pay over $1,000 more than the modeled cash flow value just to ride the momentum? Thank you for joining me for this rigorous look into SanDisk's valuation. Until next time, keep analyzing the data.